All right, rookies, welcome to today's explainer. Look, if you're watching this, I know you already understand the basics. You know how to read a standard commitment of traders report, and you know how to track managed money versus commercial hedgers. But today we're leveling up. We are stepping way past simple single market analysis to master the interconnected web of global positioning. We're going to learn exactly how to spot those high probability trades by mathematically proving when the crowd is just dead wrong.
So, here's our game plan for this masterclass. We'll build out the 4-market framework, break down the different types of divergence, show you how to calculate your daily divergence score, run through a live case study, talk macro regimes, and then finally, we'll nail down your trade timing. Let's get right into it.
Section 1. The 4-market web. You know, the biggest trap I see junior analysts fall into is thinking that gold just trades in a vacuum. Most traders simply pull up the gold COT, wait for an extreme reading, and stop there. And sure, that can be profitable, but it is completely blind to the larger global financial system. The reality, gold is pulled by this vast web of direct influence pathways between 4 core markets. We're talking gold, the US dollar, 10-year bond yields, and equities. You have to understand that when you tug on one of these threads, the whole web vibrates. You can't just look at gold. You've got to analyze the dollar because gold is priced in it. You've got to watch bonds because those yields are the literal opportunity cost of holding gold. And you've got to check the S&P 500 to gauge the market's overall appetite for risk. It's all connected.
Let's isolate the most absolutely critical pathways here. Under normal, everyday conditions, gold has these strict inverse relationships with both the US dollar and the 10-year Treasury yield. Basically, if the dollar shoots up, gold drops. If bond yields spike, which means bond prices are dropping, gold goes down. These are kind of like the gravitational forces of the market. When speculators across all these different markets agree with each other, that consensus is fully priced in. And honestly, when that happens, you have zero edge.
Section 2. Types of market divergence.
So, what exactly happens when those baseline relationships just completely break down? What happens when the positioning data actually starts lying to us? Well, that's what we call intermarket divergence. It's this wild condition where the COT positioning data from one market completely contradicts what a related market is doing. Think of it like being an ER doctor, right? If your patient comes in with perfectly normal blood pressure but their resting heart rate is sitting at 160 beats per minute, something is profoundly wrong. The vital signs are diverging. In our world, that structural disagreement between related assets is exactly what creates our maximum edge.
We're basically hunting for very specific distortions across this web. For example, a type 1 is a gold-dollar divergence. Let's say the gold COT is telling us gold is oversold and it should bounce, but the dollar COT is screaming that the dollar is also oversold and should bounce. Well, a strong dollar is bearish for gold, so we have a major contradiction. Type 2 is a gold-bond divergence, where gold positioning totally contradicts where the bond market thinks interest rates are actually going. Type 3 is when equities diverge from the pack. When these big groups of speculators start betting in opposite directions, one of them is fundamentally wrong, and man, they are about to get absolutely squeezed. And when these signals start stacking up, that's when things get really exciting.
Because that brings us to the holy grail of our framework, the type 4 triple divergence. This is the absolute maximum signal. It happens when the dollar, bonds, and equities literally gang up on an isolated gold market. Imagine this. Gold speculators are just all in long, but the dollar COT expects a massive rally, and the bond COT expects yields to spike. You've got 3 massive markets signaling a brutal impending gold correction, while gold traders are just blindly buying, usually out of pure stubbornness. Guys, this is a trap, and our entire goal is to spot it and exploit it.
Section 3. Calculating the divergence score.
Now, we absolutely do not guess in this masterclass, we quantify. Calculating your intermarket divergence score, or what we call the IDS, is a really straightforward step-by-step process. First off, you just translate the raw COT index of each market into its specific directional implication for gold. Then, you apply our structural weights. So gold gets a 35% weight, the dollar gets 30%, the 10-year note takes 25%, and the S&P 500 E-mini gets a slightly smaller 10% weight. You just sum all those values up, and boom, you've got your real-time divergence score.
Once you've crunched those numbers and have your final score, you rank the signal strength against this table. If your score lands between a plus 0.60 and a plus 1.00, you've got a strong bullish consensus. If it's deeply negative, it's a strong bearish consensus. But here is the most crucial, actionable takeaway: the override. If your isolated gold COT says buy, but your IDS score is flashing a firm strong bearish, you have what we call a red divergence flag. In that scenario, you aggressively override the single market gold signal and you trade with the intermarket consensus. Every single time.
Section 4. Case studies and practice.
All right, rookies, listen up. Time for a quick practice drill. Let's see if you can actually spot a structural distortion on the fly. Imagine you pull up your data, and the gold COTI index is sitting way down at 25. That means managed money is heavily short, making it fundamentally bullish for gold, right? But wait, look over at the secondary data. The 10-year T-note COTI index is up at 80. Bonds are extremely overbought, which means bond prices are set to fall, meaning yields are set to rise.
So here is the million-dollar question for you. Which market is actually telling the truth? We know for a fact that rising yields suppress gold, but the gold COT is just screaming this bullish buy signal. So which group of speculators is completely out of line here, and who is about to get trapped? Well, the answer, and this is based on literally years of historical case studies, is that you always trust the bond market. Always. Bonds are the ultimate leading indicator. Rate expectations are going to show up in the bond COT way before they ever show up in gold. In a scenario like this, you would actually fade the gold COT because it's completely out of touch with reality. Those gold speculators, they are early, they are wrong, and they are going to suffer a really severe drawdown before they finally capitulate.
Section 5. Macro Regimes and Dashboards.
Now, to make sure you stay accurately calibrated every single week, you need the right tools sitting on your desk. And this, by the way, is exactly why equities only hold a 10% weight in our formula. Their relationship to gold is super variable. Look, before you even think about looking at equity to gold correlations, you absolutely must verify the overarching macro regime using this checklist. In a normal risk-on, risk-off regime, stocks and gold have an inverse relationship. But if we're in an inflationary boom, they actually both go up together. And in a liquidity crisis where massive margin calls force everyone to just liquidate everything, they both crash together. You have to establish the regime first. If you don't, your equity signals are just going to be pure noise.
And here's how you tie the whole shebang together. Every Friday, without fail, you're going to plug your freshly released data right into this weekly intermarket dashboard. You just log the COT index, the conviction score, and the gold implication across all 4 of our core markets. Honestly, it takes maybe 15 minutes, max. But doing this mathematically maps the entire web for you, showing you exactly where the consensus is holding strong and, more importantly, exactly where it's breaking.
Section 6. Trade Timing and Entry.
Okay, theory's great, but how do we actually put our money to work when we see these massive signals flashing red? Well, here are your practical, hard and fast rules for timing your entries. Let's say you spot a triple divergence. First, you confirm that red divergence flag on your weekly dashboard. That gives you your big picture strategic direction. Second, you drop down to your daily time frame, and you wait patiently for your volume and order flow indicators to signal an entry strictly in the direction of that broader intermarket consensus. And third, guys, this one is absolutely vital, you widen your standard stop loss by 1.3 times. Why? Because you are actively fading the gold market's own positioning. You have to give yourself enough breathing room to survive that final, totally irrational last gasp of the trapped traders right before the intermarket gravity inevitably yanks the price down.
I want to leave you all with one final, pretty provocative thought. The market is basically just a giant machine that builds consensus narratives. But your edge does not come from blindly following that crowd. Your true edge comes from mathematically proving exactly when the crowd in one specific market has completely detached from the reality of the broader financial web. Remember, when markets disagree, opportunity emerges. So what do you say? Are you ready to map the web?